Ladies and gentlemen, good evening, guten Abend, dobrý den. Czech is a tough language, so I'm very sorry. I will stick to English, but I've got a great translator here with me, Pavel, and yeah, in the next hour we'll have some fun. We'll talk about gold, about my favorite topic, and it's a great, great pleasure being here tonight in front of such a big, big crowd here in Prague. For me, being from Vienna, I feel kind of at home because Prague and Vienna are very similar cities. And thank you very much for the invitation. And it's, of course, when the price of gold is trading at 4,200, it makes my job much easier to talk about gold. Thank you. Ladies and gentlemen, in the 2000s, everyone believed that the housing market was unshakable. Banks sold toxic mortgages as safe, the rating agencies stamped them AAA, and Wall Street toasted their brilliance. But then came a small band of contrarian investors. Michael Burry, Steve Eisman, and a few others. They saw through the mirage earlier than anyone else. But they were mocked, they were ridiculed, they were called crazy. In the end, they were right, and they made a fortune. The Big Short captured the essence of what it means to be a contrarian in a world drunk on illusions. Michael Lewis, the author of The Big Short, wrote, "It's not easy to stand apart from mass hysteria, to believe that most of what's in the financial news is wrong, to believe that most important financial people are either lying or deluded without being insane." Now, there is a fine line between genius and insanity. Today, ladies and gentlemen, the illusions are different than in 2008, but the setup is the same. Because we are told debt is sustainable and that sovereign bonds are risk-free. We're told that the US dollar will never lose its dominance, and we're told that central banks can and will tame inflation. We, the gold investors, the silver stackers, the mining investors, we are today's contrarians. We are this era's Michael's Burrys. We believe that the greatest mispricing isn't in tech stocks or in housing. The greatest mispricing is in money itself. And like the visionaries of The Big Short, we saw what others missed, and we were early in this trade. We were very early. At first, we were very few, but now, finally, the momentum is on our side. So, ladies and gentlemen, welcome to the Big Long. Ladies and gentlemen, since 1971, under this fiat currency regime, one monetary asset has stood unrivaled: gold. But most asset managers, most financial professionals, trained to worship modern portfolio theory and efficient markets, they still don't get gold. Because they assume that prices reflect all information and that risk is always neatly priced in. But ask them about the track record of fiat currencies, ask them about inflation cycles, ask them about debt cycles, or ask them about the Austrian School of Economics, and you'll get blank stares. Ask them the very simple question, what is money? And they will probably ridicule you. So what can we learn from this? Markets forget, history remembers, but gold endures. And this brings us to the heart of today's presentation. The old investment playbook is breaking down. Why? Because the classic 60-40 portfolio rested on the assumption that government bonds would always offset equity risk. But in today's inflationary reality, bonds are no longer a stabilizer for your portfolio. They've become a dead weight. They are dragging portfolios lower, while inflation risk still remains vastly underpriced. That's why in our In Gold We Trust report 2024, we introduced the new 60-40 portfolio. So what's this new allocation? It's 45% stocks, 15% bonds, 15% safe haven gold, 10% performance gold, 10% commodities, and 5% Bitcoin. Now here, gold plays a double role, as you can see. Safe haven gold, what's that? That's actually physical gold stored in safe jurisdictions with minimal counterparty risk. There is no need for active timing. It just simply sits in your portfolio as a strategic monetary insurance. And then there's performance gold. What's performance gold? That's silver, gold, and silver mining stocks. But they have to be actively managed because volatility is high. And as we know, leverage can cut in both ways. So, safe haven gold provides stability for your portfolio, while performance gold adds momentum and leverage. And together, they can be transformational. Now, is anyone here following the sport of cycling? Who likes cycling? Well, I watched this show on Netflix called Tour de France Unchained. And I always thought that cycling is a solo sport, but it's actually a team sport. There are the domestiques, they shield the leader from wind, they fetch bottles and they close gaps. Then there are the specialists, the climbers and the sprinters. They execute their roles. And then you've got the road captains. They plan the moves and they manage the risks in real time. One rider crosses the line first, but the team wins the race. Now picture the so-called Haut in the French Alps. 14 kilometers up, a vertical kilometer to gain. 2 years after his defeat, Tadej Pogačar returned determined. Team on the front, pace rising, then the launch, the sudden attack.
It looks like it's the final kilometer to climb.
Vingegaard can't go. Vingegaard cannot respond, and Pogačar attacks. Now the world champion puts in a hammer blow, and Vingegaard cannot respond in any way.
Vingegaard looks behind. It looks always just a bad moment, but he's not totally exploded yet.
So why am I showing this little video about cycling? You probably cannot comprehend this achievement of Pogačar. That's 445 watts of power, about 60% of 1 horsepower, sustained on a big wall. He flew up the mountain at 25 kilometers an hour. And after this attack by Pogačar, within a few moments, the race, the Tour de France, was transformed. Now, how is that connected to gold? That's exactly where we are in this gold bull market. Safe haven gold has been the domestique carrying us through the pandemics, through the wars, through deficits. But now the leadership shifts. Now it's time for performance gold to shine. So right now, like Pogačar on the Haut, we enter a new phase in this bull market. Now gold miners and silver miners, they are starting to outperform. And this is a sign that this gold bull market is now in a completely new phase. We're now in the strongest phase of this bull market. And if past golden decades are any guide, the final ascent will be breathtaking. Now we've seen how every golden decade begins in skepticism. It builds through crisis and rewards those who act before consensus. But let us now dig deeper into 3 key forces that will shape the second half of this golden decade: monetary excess, geopolitical shifts, and systemic distrust. The first one is monetary excess. Gold thrives when governments cannot resist the printing press. On long-term averages, M2 has grown at 7.4% per year. And after 3 years of stagnation, the global money supply is rising again. My friend Larry Lepard, he argues in his book that the big print, the next surge of monetary expansion, is not a possibility, it's actually a certainty. And who knows, perhaps gold is already smelling the next big print ahead. So this debt-based monetary system is compounding, but it's compounding with diminishing returns. And guess what? Debt without growth is an open invitation to gold. The second trigger, geopolitical shifts. The US still acts as the world's payment back office, so every dollar transaction flows through its system. But China, Russia, and others are now building rails that bypass Washington. For 3 years in a row, central banks bought over 1,000 tons of gold. And the first half of 2025, net purchases reached 483 tons. And this will continue, ladies and gentlemen. The last central bank gold survey shows that a record 43% of central banks plan to boost their own holdings. So Poland, China, India, Russia, they're not diversifying. They are remonetizing gold. And this is something that's been unfolding, ladies and gentlemen. What does this chart tell us? It clearly shows that trust is moving away from US treasuries back to gold. Gold's share of global international reserves rose to 26% recently, the highest in 30 years. Now, who knows this gentleman? Dwayne "The Rock" Johnson, exactly. Now, we used an analogy from the world of professional wrestling, when the bad boy becomes the good guy. Dwayne Johnson in professional wrestling, he was the bad guy, but he was so popular that the audience said, we want this guy to be the good guy. And then, of course, he became an action star. And this is not only happening in wrestling, it's also happening in central bank behavior. The bad boy gold becomes the good guy. Central bankers are now signaling a rediscovery of gold as a neutral, non-inflatable monetary anchor. The bad boy becomes the good guy. And the third trigger is systemic distrust. As trust wanes, physical gold demand is surging, revealing a fragile system. People want physical gold now, not paper contracts. That's a big, big change. So London vaults are draining, metal is moving across the Atlantic, and COMEX deliveries keep rising. The message is crystal clear. Investors want real bullion, not paper claims. And it's not just the fundamentals that are convincing, it's also the technicals that confirm our view. Gold has broken out of this long-term cup and handle, completing the 2020 to 2024 base. All the pullbacks are shallow and they're quickly absorbed. Now, what does that mean? It means that there's so much capital, so much money waiting on the sidelines that people have missed this gold train and now they want to get in, buying into every minor correction. And ladies and gentlemen, gold is not a contrarian asset anymore. We are now in this so-called public participation. The so-called Dow theory shows that bull markets move in three phases: accumulation by the contrarians, public participation as the story spreads, and finally, excess, the blow-off mania. We are now in the later stage of this participation phase. The gold story is resonating more broadly. Prices climb, and analysts get much more excited. But despite growing interest in gold, institutional allocations, they remain strikingly low. Isn't that interesting? Family offices, ladies and gentlemen, at the moment, they hold 2% of their portfolios in gold and precious metals, about the same as in art or infrastructure, and far below allocations to private equity, real estate, or even cash. 2% in gold for family offices, that's not a hedge, that's pocket change. Now, do you know what I see in my daily business? I'm having lots of conversations with pension funds, institutional players, and they're owning 1 to 2% gold in their portfolios. They are now all considering selling gold at these points and taking profits. Ladies and gentlemen, this is not how a secular bull market usually ends. Now, friends, investors, journalists, they all ask me, isn't gold already way too expensive? And what do you think my answer is? No, it's still actually pretty cheap. And this is usually the moment when they look at me as if I should be escorted out by the medical staff. So have a look at this table, ladies and gentlemen, where we compare the current gold price to the secular highs in 1980 and 2011. And then we compare it to the growth of the monetary base, the M2 money supply, and federal debt. And as you can see, since 1980, the peak of the first big golden decade, the monetary base, ladies and gentlemen, is up 3,500%, and the federal debt exploded more than 4,000%. At the end of the second golden decade, debt has risen 150% and M2 131%. So gold, by contrast, is up to a lesser degree, far behind the growth in money supply and debt. And remember, in both 1980 and 2011, the US dollar was far weaker. So look at the US dollar at secular peaks, way lower. Now have a look at this chart showing the long-term picture of the US dollar and the long-term secular bear markets. Now, ladies and gentlemen, Donald Trump clearly wants and he needs a weaker US dollar. And recent moves suggest that he's getting exactly that. The dollar index has broken key long-term supports, just as in past secular bear markets. But have a look at those big bear markets, 35%, 51%, 40%. So far, nothing has really happened. Now let's briefly talk about gold's monetary renaissance. Gold from a monetary point of view. The shadow gold price is the CDS of our monetary system. It asks a very simple question. What would gold be worth if the monetary base were backed by gold? And with a 25% backing, the price of gold would have to be $5,400 US. With a 40% backing, 8,600. And with 100% backing, 21,600. So ladies and gentlemen, this is not a forecast, but it's a mirror, and it shows two truths. First, monetary expansion has been massive. And secondly, gold remains deeply undervalued as a monetary good. So history proves it, ladies and gentlemen. Until the mid-1990s, high gold coverage was actually the norm. In the 1930s to 1940s, and again around 1980, gold even backed over 100% of the monetary base. Now, if it happened before, why shouldn't it happen again? Now, how does it look if we compare the market capitalization of gold to the market capitalization of US equities, US stocks? At present, gold's market cap is just 38% of US equities, which is exactly the long-term median, a far cry from the 160% that we reached at the peak of the 1970s. Now I ask you, ladies and gentlemen, again, do secular bull markets usually stop at median values? No, they end at extreme values. Now let us talk about performance gold now. Who of you here like silver? So in every golden decade, gold sprints first and then it slows, but the real firework, it usually comes in the second half of the decade. So gold was up 73% in the first half of this golden decade. More than in the 2000s, but behind the 1970s. If history repeats, gold could hit $6,800 US by decade's end, and a parabolic finale like in 1980 could even mean 11,000 US. But silver, the restless little brother, silver tends to go wild late in the cycle. A repeat of 2011 would put us well into triple digits. And the miners, they have lagged badly so far. But this is typical. Weak starts often precede spectacular catch-ups. So ladies and gentlemen, gold always goes first. But in the new stage of this bull market, this is the stage where silver really starts outperforming gold, where mining stocks start outperforming gold. And this is where we are now. Now let's talk about silver, ladies and gentlemen. The gold-silver ratio is currently around 80. Silver just made new all-time highs. And we all know that a major driver is the 140% increase in demand for silver in photovoltaics. This has led to 4 consecutive years of supply deficits, nearly 800 million ounces of silver gone. Now, what is holding silver back is investment demand, which is still tiny at the moment. But this is now changing as silver is picking up momentum. And once investors really return to silver, to the tiny silver market, this will be the perfect storm. So silver is cheap, silver supply is very, very tight, and silver is performance gold, ready to outperform. So silver is cheap, but let's have a look at the gold-silver ratio in different scenarios. So this is the gold-silver ratio, and this is the price of gold. And this is actually where silver would have to go in various scenarios. Under our base case for gold at $4,900, if we just go to the long-term median, the price of silver at a gold-silver ratio of 60 would have to go to 82. If our long-term inflationary scenario with gold at 8,900 materializes, and we'll see a gold-silver ratio of 148, that would be a silver price of $148. Now that would be the historic mean of the ratio at 60. But again, do bull markets usually end at mean or extreme values? I think you know the answer now. Now what if we go to $8,900 and a gold-silver ratio of 10? Well, that's pretty easy to calculate. That would be a silver price of $890 per ounce. How does that sound to you? I don't want to make this as a prediction, but we cannot rule it out, ladies and gentlemen. Now this chart is one of my very, very favorite charts, ladies and gentlemen. It shows a ratio between gold and the S&P 500, silver and the S&P 500, the HUY, that's the gold bucks index, or mining index, and the S&P, and the BCom, which is the Bloomberg Commodity Index, a broad commodity index versus the S&P 500. And what you can see now, as I've said before, gold always goes first. But now silver is following. The mining stocks are following. What hasn't really followed yet are commodities. So from my point of view, commodities, they are still lagging, but they're next. So I'm very, very excited about the risk reward in the commodity space as well. And we can see that in platinum, in palladium, and in copper, for example. So this is the Autarcam moment, where performance gold is now launching an epic attack. Now, who of you owns Bitcoin? I know that it's a very controversial topic. Many people in the gold camp, they hate Bitcoin, and many people in the Bitcoin camp, they hate gold. But Bitcoin is like the small, little monetary brother of gold. The market cap of Bitcoin is just 2.5 trillion, so that's roughly 10% of the market cap of gold. The Bitcoin to gold ratio has been steadily climbing, reflecting a growing acceptance of Bitcoin, not as a tech novelty, as a tech innovation, but as a monetary asset with global relevance. Now, what makes this particularly powerful for us as sound money investors is that Bitcoin and gold, they're not rivals. They are complements. They complement each other. Gold remains the ultimate analog collateral, physical, unforgeable, and universally recognized. But I think that Bitcoin has done a tremendous job over the last couple of years. And I think that the combination of gold and Bitcoin totally makes sense. And this is what we're doing in 2 of our investment funds, actually. Now, the key question, ladies and gentlemen, is when does the big long end? When will it be time to become a little bit more cautious on gold, on silver, and mining stocks? And this brings us back to our Tour de France analogy and the story of the Big Short, where timing is everything. Now, there are many ways to judge the finish line: fundamentals, technical analysis, gut feeling, sentiment, or astrology. Our conviction is that a quantitative monetary approach anchored by scenario-based price targets offers the most robust framework to assess where we stand in this bull market. So in the year 2020, we introduced the incrementum gold price model. And back then, we forecasted a gold price of $4,800 by 2030. Many ridiculed us. They said, those guys are crazy. How can they predict $4,800? But the model has stood firm. Now, what's the model actually? It rests on two pillars: money supply growth, which sets the long-term trend, and the implicit gold coverage ratio, which spikes when trust in fiat breaks down. Now, our base case still points to 4,800 by the end of this decade. And gold has already vastly surpassed our interim target of 2,900. But from my point of view, like in the 1970s, in a 1970s style storm, $8,900 is not a fantasy, it's plausible. And this is actually a compound annual growth rate of 19%. So if we want to get to $8,900 by 2013, that's 19% per year. You know how much gold is up since the beginning of the year? Almost 60%. So what do we learn from The Big Short, ladies and gentlemen? Success is not about spotting what others miss. It's about knowing when to step aside. So Steve Eisman sold before Lehman collapsed. Michael Burry closed his fund after $2 billion in profits. So dear friends, dear gold investors, dear silver stackers, dear mining investors, dear sound money community, let's capitalize on this bull market that we have in gold and in silver. Let's capitalize on this generational opportunity. Let's enjoy the momentum and let's ride the bull. But don't get carried away. You don't have to hold forever. Try to recognize the final stage just before the music stops. And when that moment comes, we'll be here to help you with the timing. So, thank you very much, Pavel. Thank you very much for your attention. Dankeschön and dziękujemy. It's a tough language.
Za pozornost.
Dziękujemy. Za pozornost.
Za pozornost.
Za pozornost. Okay, thank you very much.